Opendoor stock just popped over 14% on Friday, and no, this wasn't on the back of any earnings report or major company announcement. There was no deal disclosed, no product reveal, no analyst upgrade. So why the sudden move? Why did Opendoor, a stock that's been under constant pressure for months, suddenly come alive? Well, the real answer might be less about breaking news, and more about positioning, retail positioning, short interest, and anticipation of what could come next. Let's break it down. First, Friday's rally wasn't random, even if it seemed that way on the surface. This was a day when the broader market was relatively calm. Yet Opendoor surged double digits and closed the session at $2.10 per share, marking one of its best days in weeks. That kind of move doesn't happen without significant buying pressure, and in this case, it looks like retail traders are starting to circle back. And here's what's even more interesting. Aftermarket trading showed early signs of bullish continuation, suggesting this wasn't just a one-and-done rally. This may be part of a broader sentiment shift. We've seen this story before. A heavily shorted stock, a beaten-down share price, a major earnings catalyst just around the corner. It's the perfect setup for a speculative run. And if you've been watching Opendoor lately, you've probably noticed something strange happening in the background. Because even though the stock had fallen back from its meme stock peak in July, the energy never completely left the room. The short interest stayed high, some estimates still have it well above 20% of the float. The call option volume remained unusually active. And sentiment on social forums like Reddit and StockTwits didn't go cold. It just got quiet. But now, it might be starting to wake back up. And that's where this 14% pop on Friday gets interesting. Because it may not be about fundamentals yet, but it could be about what traders think is coming. Next week, Opendoor is expected to report its Q2 earnings. And while Wall Street remains cautious, some even bearish, there's a growing pocket of traders and investors who believe we could see something surprisingly positive. Maybe not a massive profit. Maybe not a full turnaround. But maybe a step in the right direction. Here's why that matters. Earlier this week, Opendoor's board made a quiet but telling move. They postponed the shareholder vote on a reverse stock split. That vote was originally planned to help the company regain NASDAQ listing compliance, as the stock had been hovering dangerously close to the $1 mark. But instead of going through with it, the board chose to hold off. That decision alone is a strong signal. If the company were desperate to stay compliant, they would have pushed the reverse split through. No questions asked. But they didn't. And that suggests something subtle, but powerful. They might know something we don't. Maybe it's as simple as confidence in next week's earnings. Maybe it's confidence that natural market dynamics will lift the share price above compliance levels without needing a split. Or maybe it's a sign that internal projections are improving, faster than the market has priced in. Whatever the reason, that delay sent a message. A quiet one. But the kind that traders pay attention to. Now, back to the rally. There's no media buzz. No earnings preview. No leaked memo. But there is a pattern, one we've seen in other meme stocks before. Retail sentiment builds slowly. Traders notice call option volume picking up. A few bullish posts on Reddit float the idea of a reversal. Someone points out the high short interest. Someone else makes a chart comparison to Carvana. And suddenly, the momentum snowballs. In Opendoor's case, there's already a narrative in place. This is a disruptor in a legacy industry. They're tech-enabled, data-driven, and positioned for the long-term evolution of real estate. And in the short term, the company has already cut costs, improved unit margins, and is working toward profitability. That's what makes this moment feel like a potential turning point. Because if next week's earnings show even modest improvement, narrowed losses, positive EBITDA, improving conversion rates, then retail sentiment could go from warm to white hot. And if that happens, we're not just talking about another 14% rally. We're talking about the potential for a short squeeze. Let's not forget, many of the traders who shorted Opendoor in the $1.20s, $1.30s, and even $1.50s are still underwater. That's a dangerous place to be with earnings looming. And if the stock starts to climb on strong results, or even just a positive outlook, those shorts might start to cover fast. That's where the squeeze dynamic kicks in. And if retail jumps on that momentum, we could be looking at a rapid surge, not to all-time highs, but possibly back toward the $2.50 to $3 range in the short term. That's not a prediction, it's a scenario. But it's one worth watching. So what should we expect heading into next week? 4-1. Volatility. If Friday's action is any indication, traders are starting to position themselves ahead of earnings. Watch pre-market volume, unusual options activity, and any commentary from analysts or funds. Even a vague upgrade or a fresh price target could add fuel to this speculative fire. Second, pay attention to the sentiment indicators. Google Trends, Reddit mentions, StockTwit sentiment. These are the early warning signs that retail momentum is building. And when that happens ahead of earnings, the reactions are often amplified, both up and down. And finally, keep in mind that none of this is guaranteed. Opendoor could easily report mixed results. The housing market is still shaky, consumer confidence is fragile, and the path to profitability is long. But what the market cares about right now isn't whether the business is perfect, it's whether the business is improving. If Opendoor can show it's moving in the right direction, if the numbers tell even part of that story, and if retail is ready to pounce, we could be looking at a very active few days. So is this the beginning of another short squeeze? It's too early to say, but all the ingredients are back on the table. A heavily shorted stock, an improving narrative, a bold board decision to delay a reverse split, a real estate sector slowly finding its footing, and most of all, a retail crowd that hasn't forgotten what's possible when sentiment shifts. Opendoor is still a risky bet. No question about it. But sometimes, risk is what brings reward, and as we head into earnings week, all eyes are back on Open. Let me know your thoughts below. Are you buying ahead of earnings? Are you sitting on the sidelines? Or do you think this rally has already run its course? Either way, buckle up. This could get interesting.